Hi, Juan.
Hi, can you hear me?
Yes, sorry about that. We had some technical issue. I see 7 people now, so it's working. Earlier, it wasn't like the live wasn't working. Say hi, everyone. I see people there. Okay, so Juan, thank you so much for taking the time to join me. So I'm gonna give a short introduction to Juan, and he can introduce the rest. So I met Juan through Facebook. He's a tax expert. He knows a lot of stuff. His website is even called the Tax Problem. So he solved a lot of tax problems. He's an enrolled agent, and you went to law school and stuff like that. So yeah, Juan. So why don't you introduce yourself? Tell us more what you do and and stuff like that in case I miss anything.
No, perfect. Thank you. Thank you for having me. So yeah, I'm an enrolled agent. My background is in accounting, and I have a law degree as well. So that certainly helps with understanding a lot of the fundamental arguments and how to formulate these arguments when we're researching the law. When people think about tax professionals, they don't really think of it as law. We only think of attorneys as dealing with the law, but really everything we do in tax is law. It's tax law at the end of the day.
Yep,
But of
exactly.
course, tax professionals don't call themselves tax attorneys.
Mm-hmm.
But anyway, nonetheless, the background in law certainly helps me in the work I do. So a lot of the work I do is I defend a lot of audits. I defend a lot of taxpayers who already have debt. So we figure out the best way to get out from underneath that. What is the way we save them the most money? Sometimes we could make a really great settlement where I've had cases where somebody owes $350,000 and we settle for under $1,000 and the debt goes away permanently. I've had many cases where people owe between $30,000 to $50,000 and we literally settle for $1. So when the circumstances are right, we can reach some really great settlements. And I defend a lot of audits with the IRS and at the state level as well. Defend businesses and audits with like sales tax audits, EDD, which is the state payroll audits here in California. And then the other part is, of course, helping taxpayers stay compliant. A lot of my clients own real estate investments or are small business owners. Being here in Silicon Valley, a lot of my clients have receive RSU or ESPPs or incentive stock options and all these different kinds of stock options. So helping them figure out the best way to leverage their position so that they save on taxes at the end of the day. So
Good.
all
And
things
then
tax, 365 days a year.
wow, yeah, you work hard. And then Chris here says fighting the IRS over a tax audit. So you're in the right place, Chris. So you should probably connect with Juan after that. So okay, so tell us more. Like, what you went to law school, right? Like, what did you focus on? Like, then why did you switch to tax? Like, why tax? So how was your history? I know you're talking about your career. You were in, doing in corporate or something, and then like you went major, and then now you're like full fledged entrepreneur and doing all this stuff. And why resolution and why tax? Like, what about that interests you?
Well, the reason I actually was already in the tax business before law school. And
Mm.
what happened was I kind of fell into it like a lot of people by accident. Someone was preparing my parents' return and they were making a lot of mistakes. And I decided their return was pretty simple. So I took the classes I needed to prepare those basic returns. And then friends were asking me to prepare their returns. And, I went through the proper channels, got all the licensing,
Mm-hmm.
but I started with real basic and real simple returns. And this was while in college. Then after that, I went into corporate America.
Mm.
I knew corporate America wasn't for me long term, but I definitely stuck around long enough to learn quite a bit and got a bunch of promotions pretty quickly. And then at that point, I was already midway through law school, so I just focused on my own tax practice full time, finished law school, and
Mm.
just kept going. So
Cool. Okay, so Chris, oh, sorry. Chris is asking, should I let my current CPA finish my unfiled taxes before I go to an EA or switch now? I don't feel a CPA fight these issues. Yeah, you have to go to a tax resolution expert, and that's what Juan is. So Juan, you you tell him what needs to be done.
yeah, let me explain a little bit about that. That is a really, really good question. And the way I describe it to people is think of like doctors. If I have cancer, I will not go to a pediatrician because a pediatrician's probably going to kill me, right? They just don't know how to deal with cancer.
Yes.
They don't help cancer patients, right? So your
Mm-hmm.
traditional CPA or tax advisor, if they don't have experience in collections or unfiled return area, they're not going to be familiar with the rules and the way the system works and what the requirements are, because it's really about being strategic, especially if you have many unfiled returns. Because let me give you an example. The IRS will consider someone compliant if they've
Mm-hmm.
filed their last 6 returns.
Mm-hmm.
So sometimes people have come to me after having gone to a regular tax preparer or tax advisor or CPA, where that CPA didn't know that and had them file 10 or 15 years worth of returns, when in reality they only would have needed to file 6 maybe. And then
Mm-hmm.
another strategy is we'll look at all of the records, your account transcripts, which basically are the records the IRS has. And then if it makes sense to file returns that are older than 6 years, then we'll go ahead and make those filings if it's going to save you money. But at that point,
Mm-hmm.
it's optional and we're going to do what's best for you. So, long story short, if you know you will have liabilities and you have unfiled returns, your best bet is to work with someone who has experience in this area. So, nothing negative against CPAs, nothing negative against enrolled agents, but not all enrolled agents have experience in this area. So, whomever
Exactly.
you work with, make sure it's someone who does have experience in this area so that you get the best
Mm-hmm.
help and the best result at the end of the day.
Exactly. So,
Exactly. So
Chris, we should connect with Juan. So, I'll be tagging him and on the post. So, feel free to connect with him after. Okay. Um. All right. So, Jennifer asked, "Do you have an LLM?" I'm not sure what that is.
No,
Or
an
do you mean?
LLM is like a master's in tax, which sometimes people who are attorneys will go get an
Oh,
LLM. I'm not an attorney, I'm an enrolled agent, and I do not have an LLM.
okay.
But
Uh.
one of the things that's interesting is a master's in taxation are essentially mirror a lot of the masters in an LLM curriculum,
Mhm.
and a lot of those classes are classes I could teach. So at the end of the day, nothing in a classroom is more valuable than actually knowing how to do the work.
Exactly. So Juan knows what he's talking about. So don't let that deter you. Okay. So yeah, and I know masters, that's MST, right? Masters in taxation. Okay. Yeah, I was looking at that program too. So maybe one day, maybe later. I'm starting to get a headache reading all these taxes. So I'm not sure if I want to go that route yet, just yet. All right. So Juan said, so okay, just tell us more about your common tax problems. I know your website is called thetaxproblem.com, right? So you are solving people's problems. So tell us, what are all the common problems you get, usually, and then like how can, we help people just avoid those common tax problems?
So I think, the top things I see are sometimes people who are self-employed end up making more money than they realize they earned during the year, and they come to find out what their profit really was when they prepare their tax return. They have a large liability they can't pay. So that's one big reason. A second reason, and it's understandable. Sometimes there are financial hard times, but people will take large amounts of money out of retirement accounts, hundred thousand
Yep.
dollars, 150. I've seen up to
Hmm.
$400,000. They're under 59 and a half. So they get
Really?
a penalty at the federal
Yeah.
level, a penalty at the state level, and then they also pay federal and state taxes on that money. And very easily, over 50% of those funds could be subject to tax or are taxed,
Yep.
and so that leads to a large liability that goes unpaid.
Hmm.
Another reason is people will get audited. There's something wrong on their tax return, or there's a red flag for some reason. They're selected for audit, and then the audit doesn't go very well. So they're left with a huge liability. And the way the audits usually work is there are a few reasons people get audited. One, if there's a red flag. Two,
Hmm.
just random selection. Three, if someone notifies the IRS that there's some funny business on your return. Another way people get audited is if their tax advisor is actually been in some kind of trouble with the IRS. So the
Hmm.
IRS, when they start auditing people, they keep track of who the preparers were. And if they
Hmm.
start to see a pattern that a particular, there's a whole lot of people being audited because there's things incorrect on their return and they happen to have the same preparer, then they'll start looking at more clients of that particular preparer. So a
Mhm.
bad preparer can also be a reason you end up being audited. And then of course there's just the randomness of the audit, right? Like throwing a
Mhm.
dart at a dartboard, and wherever it lands, those people are selected for audit. The other thing is
Oh,
roughly 160 million returns are filed annually, and there are only around 600,000 to 700,000 returns that get audited. So it's a
okay.
very, very low number of
Wait, you
returns.
said 167 million in US and then about
160 million,
700K gets audited.
yeah, about 160 million returns filed, around 600,000 audited. So the
Well, that's
percentage of audit is
that's
really
really
low.
low.
Yeah, it's like 0.5% pretty much. Really
Oh,
low
well,
number.
yeah.
But here's the thing, and it's stated in IRS guidance. When they audit someone, they make sure it's the result is painful, right? That's why you hear nightmare stories, because the IRS
Oh,
knows they can't audit everyone. So what they
yeah.
want is they're going to be really detailed and find as much liability as possible, and then on top of that, they'll add a 20% penalty and interest. And
Mm-hmm.
because they want you to tell your friends how terrible this experience was, because they
Mm,
want to scare people into compliance.
yeah.
So, and it's one of their stated objectives to make sure the results are terrible, so people tell their friends about their
Good
pain.
strategy. But yeah, you don't want to be audited then because that you don't want to have a painful experience. So okay, so out of all of this, so okay, if they're gonna pick someone to audit, then they're gonna make sure that it's worth it, right? That they can get as much liability or whatever penalty, right? So they kind of hence like those that might owe a couple of $1,000s, right? Because otherwise, then it's like a wasted effort, is it?
Yeah. Yeah,
Mm-hmm.
yes and no. So
Okay.
there are different types of audits. There's some that are automated basically,
Mm-hmm.
and they start by people receiving a notice called a CP 2000.
Mm.
And what it says is we think there's something wrong, and the notice will tell you what it is. And it normally gives you about 30 days to
Ah,
respond. You
okay.
always want to respond. If you ignore it, then it becomes a deficiency.
Yep, yep, exactly.
So you want to respond to the opportunity to tell them they're wrong. And those notices actually, not being political in any way or any of that, but they usually tend to go after the lower income taxpayers because they're really focusing quite a bit on a lot of the credits related to having
Oh, yep,
children, like
yep.
earned income tax credit,
Exactly, exactly. Those.
household child tax credit,
Mhm.
education credits.
Yep.
And and what's really sad about that is it's not that a lot of these people don't qualify, it's just they don't know how to respond to these notices because it's pretty technical in nature, and they end up getting disallowed, which leads to tax debt, and then snowballs
Mhm.
from there, kind of thing. So that's one kind of audit, these
Got it.
CP 2000 notices. The
Got it. Okay.
second type of notice is when you get something called an IDR,
Mhm.
information document request, and that's when they've actually assigned an auditor to your file, a revenue agent or something
Mhm.
called a TCO. And what happens is they send you a letter asking for a whole bunch of things. And in reality, they don't need half the stuff they're asking for, but they ask for everything under the sky, right?
Yeah.
And then here's where you are, it would really benefit you to make sure you have representation, because that way, for example, I'm hired by someone to defend an audit. The first thing I do is I define the scope of the audit,
Mhm.
because my goal is to minimize the damage to my client, right? That's my number one objective.
Mhm.
And sometimes miracles do happen. Let me tell a story here. So I had a client, this been, I don't know, maybe about 3-ish years now, where 4 years, where their accountant, they received a notice of audit, and the accountant said, okay, I don't handle audits, let's contact Juan, he's great at this, and let's have a meeting. What had happened is this particular client had been away for 7 years,
Mhm.
and when before they left, they owned two auto repair shops,
Mhm.
and they were sole proprietors, so there were no corporations or partnerships or anything like that involved. And
Mhm.
what happened is they made a handshake agreement, so there wasn't anything in writing, a handshake agreement with two employees, one at each location. And the agreement they made is employee A, for location A, you run this shop as if it's your own. You keep, you bill the clients, you fix the cars, you buy the parts, you pay all the bills, you keep all the profits.
Mhm.
Employee B, same deal. And the only thing the owner wanted was when I return, I'm taking my ownership back of my shops. So everything was in his name while in his absence, right? The leases were, the utilities were,
Mm-hmm.
the licenses all were in his name. Sales tax permit was in his name, the resale permit, every merchant account, everything you could imagine was in his name. So he was gone for 7, 8 years. The audit started once he'd returned because no returns had been filed during that period.
Oh.
So initially, I interview him, I interview the employees, I do my research, and what I basically landed on is I'm going to argue that this guy didn't have a business, that he wasn't in business during this audit period was a 6-year period. So they weren't
Mm-hmm.
auditing all the years he was away, just that 6 years, like I'd mentioned earlier, where the
Yeah.
IRS normally will consider someone compliant if there are 6 years worth of filings. So
Mm-hmm.
so what I argued to the IRS was that my client was not in business during that time. First of all, what is a business? We all know what a business is, but from a legal perspective, there isn't anything in the Internal Revenue Code that actually defines it. So when
Yep.
that's not the case, then we look at the case law, and in the case law, a lot of the cases that deal with definitions of businesses are really where the IRS is arguing that something is not a business, right? Like the hobby cases. So they did a really great job of being creative and helped me figure out the types of arguments I would be making on behalf of my client.
Mm-hmm.
And to make a long story short, I argued he was not in business. I argued that the assignment of income doctrine also applied, which means if person A earns the income, they cannot make person B pay taxes on that income. So I argued that these other individuals earned the income and kept the money, so they shouldn't be making my client pay taxes on that money.
Okay.
Argued importantly as well that these guys were not his employees during this entire period,
Mm-hmm.
because if it were deemed that they were, then he would have been on the hook for payroll taxes as well, which would have been hundreds of thousands of dollars.
Yeah. Yeah.
So at the end of the day, they sent this file over. They didn't want to make a decision here in the San Jose office. They ended up sending the file to counsel in San Francisco. We heard back months later. This case took about a year and a half. Once I submitted all of this, it took about 6 months to get an answer back. And they said, Juan, we're not saying you're right, but we're not saying you're wrong. But we'd rather not really figure out whether you're right or wrong because we can see these arguments prevailing. So
Yeah.
let's just make a deal. And originally the estimates were that the client would owe about $1 million in taxes out of this.
Wow.
And the settlement was he only paid $5,700 in tax.
Wow. That's
For,
that's
for,
awesome.
for a 6-year period that he was audited. So
Wow. And then like how long does this take you from the start to the finish?
this particular case took about a year and a half from the very beginning to a final resolution and signing everything.
Wow. Wow.
So
That's
audits take a long time. Even a pretty quick audit is a 6 to 8 month project oftentimes. Because
wow. Wow. So how many resolutions are you handling at a time?
it really varies, but I probably always have somewhere between 30 to 50 ongoing cases.
What?
Yeah.
How do you manage your time? Like, don't you have an assistant?
It works. For me, I'm an early bird. So for example, today I was up at 3:30 in the morning getting some work done. I worked from 3:30 to 7, and then had I was having coffee throughout. Then I went on an hour and a half run, then came back, showered, and prepared for this. So even during the week, I manage my appointments, try to keep everything early. I get up early
Wow.
so that I'm done. I try to be done early as well.
Wow, you're a hustler. I love that. Workaholic entrepreneur. And then look at you. Like I've known Juan for a long time, and then like he has lost weight. He really got in shape, and then it's like he's just amazing. He's inspiring person. So what time do you go to sleep?
Well, actually, last night there wasn't a whole lot of sleep because I didn't go to bed until midnight, but never before 10.
Wow.
So about 10 to 11 usually.
10 to 3, that's like what? You sleep like 5 hours a night? That's
That's
crazy.
plenty. That's plenty.
Oh my God. Like now I'm feeling embarrassed by the time I woke up. You don't want to know what time I wake up or go to bed. All
Well,
right. So
not every day I wake up at 3:30, but probably at least 2 to 3 times a week I'll be up at 3:30.
wow.
3:30.
That's great that you have a very organized time. So you actually like because as an entrepreneur you have to be very careful about time management, so you got to use time block and stuff like that, otherwise you'll never get things done, right? Even I feel like being an entrepreneur, I actually feel like I have no less time than versus when I was an employee and doing this on the side. So it's kind of interesting because I guess you work a lot more when you're an entrepreneur. Okay, so let's so based because of what you just said, so there's always a question between sole proprietorship versus S corporation. So I know we already talk about this, but like if you have to give advice to people, yeah, okay, someone just asked LLC or S corp. Yeah, he's gonna get into that. So I think a lot of people always get confused. Yeah, LLC, like what's that? So maybe please explain all of that. So is it really sole proprietorship or S corp? And LLC, you only need that if you're gonna do an S corp, right? It's not needed for sole proprietorship. So why don't you walk through all of that?
Yeah, so the first thing, and it's funny, I actually taught 2 classes this week. So another thing I do is I
Mm-hmm.
teach tax professionals continuing education. I write the classes and I teach them webinars and live in person across the country. But I just taught 2 classes this week on this very subject. And here's the thing that you don't want to get confused. An LLC is think of it as an artificial person, and they get their
Mm-hmm.
rights and duties based on the state under which it's created, right?
Mm-hmm.
And when you
Yep.
form an LLC, that in and of itself has nothing to do with taxes. So you
Yep.
form an LLC, and ideally, prior to forming the LLC, you've had a chat with your tax advisor to
Yep.
then determine what you want the taxation to be.
Yep.
Because here's the thing that a lot of people forget. An LLC can actually be taxed 4 different ways, right? So
Mm-hmm.
if
Yep.
I myself go out and form an LLC and I do nothing more, make no tax elections,
Mm-hmm.
then the income and expenses for that business activity will be reported on my Schedule C on my personal tax return, really no different than if I was a sole proprietor, with
Exactly.
with the added forms that California requires plus extra fees.
Yep. $800 California yearly. That cheap here.
Minimum 800, could be a lot more. And then the other option is if there are 2 members to this LLC, 2 owners, and they make no tax elections, then by default, they're going to have to file a partnership tax return. Although
Mm-hmm.
it's an LLC at the state entity level, from a tax perspective, the partnership rules apply. That's the
Mm-hmm.
way that would work.
Yep.
And then the other thing that happens when you form an LLC, if you want to be an S corp, then you make an election. It's called making an election, and you file Form 2553. And when you
Mm-hmm.
file that form, what you're doing is you're telling the tax authorities that you want the S corporation rules of taxation to apply to you. And then
Mm-hmm.
that means you'll be filing S corp return for the life of that entity. So being an LLC has nothing to do with the method of taxation. It's what decisions and choices you're making. Then the last option for an LLC is you can file Form 8332 to ask the IRS to tax you as a C corporation if you want the C corporation rules to apply to your business entity. So as you can see, you form an LLC, but it has nothing to do with the way you're going to be taxed. So
Yep.
really, you have a lot of options with the LLC in terms of how you want to be taxed, and it really will come down to what business you're in, and what is the income level, what benefits are you looking for, because and then I also say what business you're in, because some states will not allow certain industries to be LLCs. So in California, for example, construction contractor can't be an LLC, and neither can an attorney or a CPA. So each state will have its own rules as to what industries or professions are allowed to form an LLC and provide services under the umbrella of that entity. But
Got it.
but yeah, when you think LLC or corporation, don't mix up the state entity with the tax concept. They are 2 completely different things.
Exactly. And then so Richard Grover said LLC give you corporate protection.
So today's class, we're talking about taxation, not liability. Those are good questions for an attorney. But I'll say, yeah, in general, one of the benefits of these entities is protection from personal liability. And so the only comment I'll make on that, though, is making sure that you're following all of the state requirements for your entity type. And they're going to vary between, they're different for a corporation than they are a partnership. and they're different than they are for an LLC. Because
Mhm.
if you don't follow all of the formalities, and if you're not following state law, and then if you're not following the tax law, and you're not managing your entity the way a prudent business person would, which means follow all the laws, then if there was a lawsuit, a judge can ignore the fact that an entity exists, and then you still are personally liable for whatever your employees did or whatever happened. So at the end of the day, though, that's a conversation people need to have with their attorney, and
Mhm.
be know exactly what they need to be doing to make sure they don't have that kind of risk.
Got. And I guess Richard said he meant LLP. So,
Well, same thing. All of the entities that
yep.
offer protection, it can be pierced and ignored if they don't follow the rules and don't operate it
Yep.
correctly. Yeah.
Yep. He says, excellent advice. You are very good. So, Richard, connect with Juan after, okay? He's asking a lot of questions. Okay. So, I think the other important question being sole prop and S Corp too is that should they convert from sole prop to S Corporation? I think, Juan, you were a sole proprietorship for a very long time, right? Did you just convert to an S Corp now, or are you still remaining sole proprietor? Because a lot of, we had this conversation, a lot of accountants out there or tax experts always say, yeah, switch to S corp when you reach this certain level to avoid self-employment tax. But you had a totally different opinion about that, so I was really surprised by your opinion. So why don't you tell people when should they convert to S corporation, and then what about, and then and then your history, like why did you decide to be S sole proprietorship for a very long time? And I don't know if you're converted now or you staying with sole proprietorship still.
So very good question. So I think the first thing I'll say, because there's a million YouTube videos out there that are wrong, is anybody who's telling you that this is the way you do it and the only way you do it, you're probably right, because there is no one size fits all. That's the number one piece of advice. The
Mm-hmm.
second thing is you need to look at what your cost of compliance are. A lot of the people who are trying to convince people to become S corps
Mm-hmm.
aren't telling them about the cost of compliance. When you're an S corporation, you need to track your basis, and you need
Mm-hmm.
to uh, have formal accounting, because there's no way you can have track your basis properly if you don't have formal double entry accounting. And I've never met a non-professional who understands double entry accounting. And knowing how to use
Mm-hmm.
QuickBooks is not double entry accounting. So there's going to be a compliance cost, because you're going to have to bring a professional in to do all this for you. The other thing with an S corp is you have to be on payroll. Whatever service you're
Yep.
providing for your entity, you have to pay yourself what's called reasonable compensation, which
Mm-hmm.
means if you hired somebody to do what you're doing, what would you be paying them? Right?
Yep.
That's kind of
Yep.
like the real general way to think about this. So
Yep.
you'll be on payroll. So then you're going to have the cost of payroll, for example, and the cost of payroll taxes on that income. And at the state level, California has employment training tax and unemployment
Mm-hmm.
insurance and
Mm-hmm.
a bunch of other costs, right?
Yep.
So then there's the fact that you now also need a corporate return and a personal return. That adds cost,
Mm-hmm. Yep.
right?
Yep. Yep.
And then there's in California the minimum franchise fee of $800, which could be more if the income's higher. So you start adding all of these costs, and you see that pretty quickly it can cost you $5,000 to $10,000 to meet compliance. So now let's discuss briefly where the tax savings come in. The most common where people talk about is that when you have an S corporation, or you're being taxed as an S corporation,
Mm-hmm.
you will pay Social Security and Medicare tax,
Mm-hmm.
which is 15.3% on the amount of reasonable compensation. So
Yep.
let's say the entity, after accounting for your salary, still has profit of another $70,000. That $70,000 will be taxable income to you, but you won't pay Social Security and Medicare tax on that $70,000. So assuming we're under the thresholds, which we don't need to get into so we don't confuse people, but you'd be saving 15.3% on $70,000, which adds up to roughly a little over $10,000, almost $11,000 in savings. So if your compliance costs are, let's say, $4,000, and you're saving $11,000 in taxes, then you're coming out ahead by roughly $7,000, right? So you're saving $7,000. So my other big piece of advice I give people is I ask them, well, what would you do, or what are you going to do with that $7,000 savings? Are you planning to just spend it and go visit Christine in Las Vegas eventually? Or are you going to actually invest that money or put it into retirement accounts, put it into a solo 401k, in a regular brokerage account, what are you going to do with that money? Because what will happen is that portion of profits or income is not going to pay into the Social Security system on your behalf, which means down the road, future you is going to have a lower Social Security payout.
Yep.
So current, today's,
Mm-hmm.
based on today's numbers, the max payout is roughly $3,400 a month, which is about $42,000 a year,
Mm-hmm.
right? And if you're paying, the max someone would pay into Social Security is roughly about $20,000, just under $20,000, and
Mm-hmm.
they'd be getting back roughly under today's numbers, just about 42,000 per year. So
So,
unless
so you're
unless
saying that? Oh, sorry. Go ahead.
unless people are going to invest those tax savings, they're really hurting themselves because they're not going to have a retirement fund, is what I'm saying. Their future Social Security payout will be lower for paying less into the Social Security system. And if they all didn't invest the money, then they also didn't put it away for their future selves.
Good. So you're saying so that that if they were a sole proprietorship, they're paying $14,000 total to the Social Security because half. So if that one, or like if they do S corporation, $7,000 is the only thing they pay for, and then seven. Oh wait, no. They
No.
save on
Let,
the
let
seven.
me let me explain it. So
Mm-hmm.
the portion when you're a sole proprietor,
Mm-hmm.
all of profits pay 15.3% towards Medicare
Yes.
and
And
Social
that
Security.
goes all towards your Social Security and Medicare. So that gets funded to your future self for pension. And then like if you're gonna cut into half, then only half of that will go to your Social Security if you're gonna make that into an S corp, right? So you're literally cutting your Social Security into half or funding your future self by half. So you're saying that sometimes that you might make, let's just say a random number like $100,000 profit or $200,000 profit. Sometimes it's okay to pay into the Social Security system even though it's 15%, and then it might not necessarily be a bad thing.
So I don't make decisions for people. What
Mm-hmm.
I have clients who are amazing investors, and they'd be
Mm-hmm.
better off not paying a single penny into Social Security and investing it because they're really great at what they do. But that's not an
Oh,
option, right? So they have to pay into it in some way.
yep.
But there's other people that if they had an extra $10 in their pocket, they're going to spend it. They're not going to invest it. They're not going to save it. So somebody like that, if they form an S corporation, they're shooting themselves in the foot because they're not investing in their future selves and in any way. Not only are they not paying into Social Security now, they're also not
Mm-hmm.
investing those savings, and in their
Exactly.
future they're going to be broke. Like they're
Got it.
going to
Yeah.
have a hard time in retirement. Yeah.
Yeah. So you still
So
believe in
so
the
here's
Social Security system?
I'm not saying whether I believe or whether I don't believe. What I do tell you is that the majority of people are terrible savers.
Yes, I
Before
agree. I know that. I see
right?
that all the time.
So 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 why tell somebody to do something where they're shooting themselves in the foot? Is kind of the way I see it. So,
Yeah.
pre-pandemic, there was an article late last fall that came out that said, I think 54% of Americans didn't have $500 if there was an emergency. So if people don't have $500, what makes you think they're actually going to take that $7,000 savings and invest it in something? They're
Yeah.
probably going to spend it. So again,
Yeah.
I don't make decisions for my clients. I break down the numbers. I paint the picture for them. I let them know what would happen, how it works, and then it's
Mm-hmm.
up to them to make that decision. But
Mm-hmm.
but I think one of the questions you asked is there a break-even point when it makes sense to form an S corporation? So the moment your savings exceed your cost of compliance, you're in a position where you're saving money, and the greater the savings, the greater the benefit. And
Mm-hmm.
usually, my experience is that people need to have a profit of roughly $70,000 a year before there's a financial benefit to being an S corporation. But again,
Mm-hmm.
even then, please be smart, and all those savings should hopefully go either to
Yeah.
reinvest in your business so
Yeah.
that your income keeps growing, or put it away for retirement
Got
or
it. Got it.
anything.
Yeah.
Because
That is
if you
that
do,
is That is great advice, Juan. See, you are a great coach. I love that. It's the same thing, my approach to like with my clients. I never tell them what to do. I show them all the different ways. Okay, this option A, option B, what are the pros and cons? And then you decide at the end of the day what is best for you. So I love that. I really love that approach. See, everyone, Juan is a great coach. If you have any resolution issues, whatever, go to him. Okay. So actually, okay, so now I'm curious. Let's talk about the resolution process. Like, how is that like from start to finish? Like, let's say someone got noticed and like, oh crap, what am I gonna do? Whatever. So it's like, so what should they do? Okay, besides calling you, like, how does that work typically?
Okay, let's talk about a specific kind of case because it'll vary by the type of case. So let's talk about offer and compromise. Offer and compromise is actually when someone already has a liability. It's the best program that exists because it's the
Mm-hmm.
program where you can make the debt go away for very little money.
Mm-hmm.
However, it is not a program where everyone qualifies. There's some fairly narrow criteria. And
Mm-hmm.
what they do is there's two main things they look at. They look at your
Mm-hmm.
income,
Mm-hmm.
and then they allow us to subtract what are called allowable expenses. Not
Mm-hmm.
everything's allowed, and there are limits to a bunch of things, but there's guides for all of this. The
Mm-hmm.
second area they look at is what are your assets? You know, do you have a 401k? Do you have, if you do have a 401k, can you access that money? If you
Mm-hmm.
cannot access that money, then they won't consider that an asset. But you'll look at all of your assets. They'll look at 401ks, investment accounts, real estate, whether you live there or not, you know, vacant lots. They'll look at do you have any cryptocurrency? They'll look at how much cash
Mm-hmm.
you have in the bank.
Mm-hmm.
They'll look at how much your car's worth. You know, is it, if it's a $30,000 car that's paid off, then there's equity there. Or is it a
Mm-hmm.
$30,000 car where you owe $40,000 because you know, cars lose value pretty quickly,
Mm-hmm.
and it was wholly financed from the beginning. So
Mm-hmm.
once we run this analysis, step one is getting the records and understanding what the problems are at the IRS level. So I'll get power of
Mm-hmm.
attorney. I'll get copies of all their transcripts. I'll make sure all filings
Mm-hmm.
are in, and then
Mm-hmm.
I'll look at what years have a problem. The
Mm-hmm.
next thing I do is I'll do this financial analysis that I just described, you know, their income, their allowable expenses,
Mm-hmm.
taking into consideration their family size, where they live, because this stuff is location specific. And then I'll look at all of their assets. Assuming it looks like they qualify or they're close to qualifying, then we'll do some planning. And let me give you an example of what I mean by that. I had a client that on the asset side they didn't have assets, so there was no issue there. On the income side, based on the income and then the allowable expenses,
Mm-hmm.
they they had about $600-700 in disposable income. What that means is the IRS would have wanted a settlement of roughly anywhere from $10,000 to $70,000, depending on
Mm-hmm.
what the IRS would look at. So if you owe $500,000, that's still a pretty good deal, right? But if
Yeah.
you owe $70,000, paying them $70,000, not really a good deal. Paying them 10 would still be a good deal. So it just
Mm-hmm.
really depends on how much people owe, right? But here's what we did. This is where it pays to work with someone who understands the ins and outs of this. You know, like we started in the beginning of the call, work with someone who has this experience. You know, the guides allow taxpayers. So a married couple, for example, can have
Mm-hmm.
two car payments up to $509 per month per car. And these
Mm-hmm.
particular taxpayers both had older vehicles that were paid off. And what
Mm-hmm.
we ended up doing is they each bought a car, and all of a sudden that $600 in disposable income disappeared. So now they had zero disposable income, they had zero assets, and we were able to settle with the IRS for less than $100 on over $50,000 debt. So
Wow.
just using the rules to our advantage, right? Not only were they now driving newer, nicer cars, not brand new, but newer, nicer cars, but that essentially led to them putting money in their own pocket, not paying the IRS anything, almost
Mm-hmm.
literally, because it was less than $100,
Yeah.
and debt of about $50,000-60,000 went away. The
Yeah.
only catch with an offer in compromise is that you have to be perfect for 5 years after acceptance. Now, my goal with all my clients is that I've taught them enough throughout the process that they hopefully stay compliant forever. but
Mm-hmm.
for sure they cannot make any mistakes in the first 5 years, because if they file late or have new liability, that could be a reason
Mm-hmm.
for the IRS to say they've defaulted on their offer, and then the
Mm-hmm.
debt that was previously forgiven can return if they
Got it.
don't cure the deficiency, because they'll have an opportunity, but they want to make sure they don't make any mistakes in that 5 year period for sure.
Got it. So Juan, I know you kind of do a lot of things, but like, what are the stuff you offer though? Like, you have your resolution. You probably do some tax preparation, not a lot. Like, what else do you offer, or is the majority of your work in tax resolution?
The majority of my work is in the tax resolution space and defending audits. And then in those areas, we always have to prepare returns. So there's return preparation. Then the
Mm-hmm.
other area that I have a lot of work in is because, for example, audits and tax resolution are all non-standard things, right? We have to look at
Mm-hmm.
the client situation, and then it's like a puzzle.
Mm-hmm.
You put together the best possible scenario for them, and then that's how you get the good results. So that's
Mm-hmm.
very similar to what the process is like in tax planning, right?
Mm. Yep.
So I also have do a lot of tax planning. So a lot of my clients um, are not just a W-2 filing from an annual perspective. A lot of my clients own real estate, multiple properties, businesses, a lot of these other things that go on. So we're constantly putting plans together to minimize their tax liability on a year-to-year basis, and help them increase their wealth and keep as much of their money as possible.
Got it. Got it. Okay. Cool. So, do you use a software for tax planning, or just mainly spreadsheet?
I don't use any software because, again, it's all very custom. So what you want
Yeah.
is you want to use professional tax software on the prep side, and then I end up running a bunch of simulations, a bunch of models, and the inputs are very unique for each individual thing. So
Got
I've tested out a few tax planning products, but I don't feel any of them, because at the end of the day, it's really what's coming out of here that helps you
it.
put together these models. So a
Mm-hmm.
spreadsheet and good professional tax software is
Got
what
it.
I use.
Got it. And sometimes you can even use a 2019 tax return to kind of simulate 2020, right? Because it's still kind of very similar. You're like, okay, if you change something, you might owe this much, give or take, and stuff like that, right? Okay, I
Yeah, I mean,
love that.
yeah, here's
Mhm.
an example. I met with the client this week. Here in Silicon Valley, she bought her home for $150,000, and it's now worth about 1.8 million.
Mhm.
And she's looking to sell it. So she's in the planning stages and thinking of moving forward. So one of the things, we prepared her 2019 tax return, and then she says, "Hey, I'd like to know, because I think I might sell this year, what kind
Mhm.
of a tax hit am I looking at next year?"
Mhm.
So what you just said, I took her 2019 as the basis for the model, and then I made the adjustments based on what we think
Mhm.
2020 will look like, and then included, of course, the sale of the home,
Mhm.
making some assumptions and estimates there. And then we did some planning. If you do A, this happens. If you do B, this happens. If you do C, this happens. And that's, we had discussions, for example, about step up in basis, right? Because she's in
Yep.
her 70s, and she's really, really healthy, and in her
Yeah.
family,
Yeah.
her parents lived to be into their late 90s.
Mhm.
So very good chance she's got another, 30, at least another 30 years left. but
Mhm.
my duty as a tax pro is letting people know what their options are, and I wanted to make sure she knew about step up in basis and how that would affect her heirs if she sells now in 2020 versus if they inherit this property at some point.
Got it. Got it. Wow. So 1 million, and then she's thinking of selling that. So that's like that's a huge tax bill right there.
Yeah, it's pretty
Wow.
big.
So what did you guys end up? I mean, doing, like, what's the best scenario for her in this case?
Good. Okay, so let me run through some of the things we discussed. One
Yeah.
option was, if we wanted to preserve step up in basis. Let me explain what that is in case
Mm-hmm.
people don't know. So
Mm-hmm.
in her case, she paid about 150,000 for this house back in 1980, and
Yep.
is worth now about 1.8 million. So if something were to happen to her and her heirs inherit this home tomorrow,
Mm-hmm.
her children would be treated as if they had paid 1.8 million dollars for this
Yep.
house,
Exactly.
because they get what's called a step up in basis and cost basis.
Mm-hmm.
So what that
Mm-hmm.
also means is, now in their hands, is that if they paid 1.8 million, So that means they could literally turn around and sell this house for 1.8 million, and there'd be no gain, no taxable gain. So they'd put $1.8 million cash in their pocket. Now, of
Mhm.
course, there's going to be costs of commissions and real estate and closing costs and all of that, probably about $80,000 or $90,000 worth.
Mhm.
So because the kids don't live there, they actually
Mhm.
would be able to write off a loss on their tax return to
Yep.
the tune of whatever that loss is.
Yeah.
So,
Yeah.
so step up in basis is this huge benefit, right?
Yep.
And let's say her children inherit this house in another 20 years. Well, in 20 years, it probably won't be worth 1.8 million. It might be 3.8 or 5.8 or 10.8. I mean, we don't know how much real estate will go up in another, 20 or 30 years. But step up in basis means that when the heirs inherit, they will be
Mhm.
treated as if they paid whatever the fair market value is of the property when they
Mhm.
inherit the property, or when the person passes away. That gives them the property. So one of the options was, if she wanted to preserve step up in basis benefits for her children, was to create a life estate for herself, meaning she has rights to it during her life. But for
Mhm.
example, turning it into a rental property because she does want to move in out of the area,
Got
and
it.
then letting,
Yeah.
letting her children hire a property management company and keep all of the rental income, for example. And
Mhm.
by doing something like that, she would be putting roughly $30,000 per year
Mhm.
in their pocket, each of their pockets. There's two children,
Yeah.
for the next 10, 20, 30 years, however long she
Yeah.
lives. And
Yeah.
then when they inherit, they get this property, they keep step up in basis, right? That was
Got it.
one option.
Yeah. Got
Another
it.
option is, does she let it sit vacant for a while? And she was thinking about that. So we ran through what that would look like, what her costs would be, things like that. The other thing was just, a flat out sale.
Mhm.
And that's probably what she's going to do, and pay all the taxes, because the other thing is, she's working her with her financial advisor. This home has no mortgage, it's paid off. So she's
Yeah.
going to walk away. The only thing that will be deducted from there will be closing costs, which we estimate to be $80,000 to $90,000. And the taxes she'll eventually, and everything else will be cash that she's going to have that she doesn't really need. So she's going
Mhm.
to put it in some sort of investment. and
Uh,
and then the other conversation we had is, she's planning on moving. So when she makes that move, she's going to buy a property roughly $300,000,
mhm.
and she was planning on just buying it cash. Well, I said, hey, if you're going to invest this money and you can get a mortgage for 2.8%, but if your money is being invested and earning, S&P historically has gained 8% per year, she'd still
Mhm.
be coming out 5% ahead, assuming the S&P keeps doing what it's done historically. She makes 8% on her 300,000 and is only paying the bank 3%. But again, those are conversations she'll have in detail with her financial advisor. But
Mhm.
after this brief discussion, she's like, you know what? I probably won't buy that house cash. I'll pay the bank their 3% and I'll make 8, 10, 15%, whatever, however good her money manager is on
Yeah.
her return on her investment. So that's another one of her options.
Mhm.
Then
Well,
another option was doing one of these.
oh, go ahead. Go ahead. Go to the last one. I'll ask my question.
We,
Mhm.
we briefly discussed deferred sales trusts, which is a
Mhm.
tax deferral method as well. That's pretty complex, so we won't discuss that in detail, but it would be a way for her not to pay tax on that money for many years, which means she'd get all 1.8 million and do whatever she wants with that money. So
What about reverse mortgage?
reverse mortgage would require she still owned the property and she lived there, which she doesn't want to do. So she lives all by
Oh,
herself, and it's over 3,000 square feet, and she's actually going to be moving out of state because
well,
she has no
yeah.
family in the area longer.
So okay, so if she $1 million after everything, whatever, how much is she pocketing after all the taxes and costs and everything after that?
So we estimate that after everything is said and done, she's probably going to keep nearly $1.4 million.
No, you said that she's gonna sell it for 1 million, right? That's how much it was worth now.
No, 1.8 million. It's worth 1.8 million. There's
Oh,
no mortgage.
1.8 million. Okay, got it, got it. So you said after paying whatever minus the cost basis, everything, so it's about 1.4. Wow, $400,000 all to like expenses and costs. Well, it's still not bad. 1.4
Mhm.
million over a long period of time. I mean, yeah, I'll take it. I wish I was related to her now. All right. So it looks like okay, so I'm just looking at the comment, get a low mortgage rate. Peyton said earn more on her cash on hand, invest it in different financial vehicles. Yes, I agree with that too. Because like I'm not a fan of like having to pay off my mortgage when it's like even me, it's 3.625. If I can just invest my money, I'd rather just invest it because historically I've been making good money. So I don't listen to those Dave Ramsey or whatever, like, coaches. They're like, no, pay off all your mortgage, whatever. You can be cash broke. Who cares? Just don't have a mortgage. That's like the worst thing you can have in your life. So I don't follow that rules. Okay. So it's almost at the hour. So like yeah, do you have any last words, Juan, before sharing with people how they can find you? Because I know you hang out a lot on Facebook, and I don't know about LinkedIn. If you hang out a lot there, so people want to connect with you, where can they find you? So yeah, any last words and where people can find you?
Yeah, please connect with me on Facebook. It's www.facebook.com/ the tax problem, all one word. And then on LinkedIn, it's Juan Montes, enrolled agent, and I'd love to connect with all of you. But one thing I'd like to tell everyone is, the 2019 deadline's around the corner. It's officially July 15th. So
Mm-hmm.
please, make sure you work with your advisor to either get your return filed by then or file an extension. The other thing
Mm-hmm.
that's super, super important, which is a mistake I see a lot of times, is
Mm-hmm.
the extension is an extension to file, not an extension to pay.
Yes.
So if you think you owe money, that has to be paid before July 15th, or there will be some hefty penalties to pay if you owe the IRS beyond the 15th of July.
Yep.
So
Yep.
around the corner, about a little more than 2 weeks away.
Yep, awesome. Thank you so much. And then people said, yeah, super session, Juan. Awesome. Please connect. Okay. Yeah, don't worry, guys. I will tag Juan so you can click on his name and then connect with him afterwards. Okay. So, all right, Juan, thank you so much for joining. Thank you, everyone, for joining. I really appreciate this for staying with us for the whole hour. I hope you got a lot from this and then learn some new nuggets. So, thank you and have a great weekend, everyone. Bye bye.
Thank you.
Yes.